Hello everyone, welcome back to my channel. So this video marks the end of the week number 94 in this Road to 100k realized return challenge. And this week was quite a bit different from the previous one. Were a few things that happened that I find a bit strange, but I will get to that. But so far, as the time being, as you can see, now we have our portfolio full of shares of the ETFs. Most of the ETFs that we usually get exposure to. Basically, we were assigned to almost all of them because of what happened over the past 2 days on Thursday and Friday. But we'll get to that. For so far, and looking at the economic data as usual, uh, we should start, of course, by the first highlight of the week. That was basically the CPI and the prices, which, of course, now because of the energy price increases, this is, of course, that figure 3.8%. That is way beyond the Fed's objective. And so, even though if we discount and we disconsider the food and energy to get to the core CPI, we get a much more favorable reading, even though it's still above the 2% target, and it's also above what has been recorded over the past couple of months, as expected, because energy prices have a ripple effect on the rest of the goods and services that are bought by consumers, and so this 2.8 figure and 0.4 month over month already reflects some of that ripple effect. Not only that, a real average hourly wages slipped 0.5% for the month and 0.3% annually. So with the emphasis on the word real, so we are discounted already the inflation, and because of an increased inflation, assuming all else equal, real average wages will come down, and so this is also an impact of the increase of inflation. And the bad news continued on Wednesday when we got the PPI readings, which jumped to 6% on an annual basis. This is a very, very large increase, and because producer prices tell, for sure will downstream to the consumer, to the consumer prices, we should expect that the inflation rate for the consumer will remain high and will probably still increase further, given this jump in the wholesale inflation. And here you see that the services index accelerated to 1.2%. Two-thirds of the move were attributed to 2.7 gain in trade service. So it's a sign that tariff costs could be starting to have a large impact on prices, especially this given that this delay is probably due to the fact that before the tariffs have come in, have kicked in, many wholesalers and producers basically stockpiled a lot of the goods and services that they sell, and now this can be an indication that the stockpiles are running low and they need to restock with new tariff induced prices on those goods and services that are being used to restock the wholesalers. Given this news, there even despite this thing happening, what is strange about it is that the stock market continued to rise on Tuesday and Wednesday. And of course, as you can imagine, this is quite surprising because usually the inflation rate has a negative correlation with the stock market. And so the fact that they basically both went up at the same time, this is something that it's really, really strange. Under normal circumstances, this would never happen because this would signal to the market that the Fed would be more inclined to increase interest rates, which of course has a knock-on negative effect on the stock market. But still, this was only one of the strange developments that occurred throughout this week. And given the situation, looking at the Fed funds futures, even though they are still discounting, investors are still discounting, or the Fed funds futures are still discounting a near certain probability that interest rates will remain unchanged at the next meeting on June the 17th. For the next one, or for the following one, the investors or the Fed funds futures are already discounting the 4.2% probability of a 25 basis point increase, which becomes ever more likely for future meetings. And we can see here already in the September meeting that by this time there is already started to be discounted the possibility of 2 rate increases by September, and this probability only continues to increase for future meetings. And here you can also verify that the 25 basis point cut remains relatively unchanged across the maturities, and yeah, basically it is becoming almost an impossibility to lower interest rates given the inflation readings that we are still witnessing. Now, in my opinion, and I may post another video on this, I don't see why interest rates would be increased to basically curtail this inflation rate, this increased inflation, because this is clearly a supply side inflation because of all the restrictions that exist on the oil markets given the closure of the Strait of Hormuz. And if you know economics, as I'm sure most of the Fed members know, if the interest rates basically, or yeah, the focus of the interest rates is on the demand side of the inflation. And we know from the data on wages, the data that we are also witnessing in terms of the purchasing power of the consumers, that this is clearly not a demand side inflation, especially in the case of the United States, in which we are witnessing more and more the effects of a K-shaped economy, in which only half of the population, the ones with higher incomes, are basically dragging the economy along, or the rest of the economy along, in making all the consumption or most of the consumption, and that of course offsets the consumption that lower income households are doing. And so this is something that the Fed, by increasing interest rates, will not solve, and unless the oil and energy markets come back to normal, this situation will not change unless something very significant happens. And yeah, but this is the way things are at the moment. We also see in terms of the rest of the economic data on Thursday that nothing really remarkable happened. The rest of the events are not basically market moving. There was a slight increase on the jobless claims, and in here we can tell, and this is a positive thing, that the Empire State Manufacturing Survey came very much above what was predicted, because this is the number in the middle. The middle is the medium forecast, so a very large increase from both the previous month reading and also the forecast. A fall or a decrease was predicted, and instead came way above. Industrial production came much better than in the previous month and much better than what was expected. And so, yeah, this is a situation that we have really to have a good look over the next couple of weeks. Now, as things stand at the moment, we also know that next week is going to be a very important week in terms of earnings. Not because of the amount of companies that are reporting, but because on Wednesday we have the big daddy of them all, Nvidia, reporting the earnings, right? And so this is going to be a very much a big focus of the market to see what comes out of this. On Thursday we have Walmart, but that is the only real notable company that is reporting earnings and is not will not for sure move the needle on the market, but Nvidia certainly will. Um, we know as well that the earnings that have been coming out this week have been also more of the same. Earnings have continued to be above expectations and have been coming thick and fast and very good ones. But yeah, the market really acted in a very erratic way. And now, moving on to what actually pertains to our challenge, we can see here, I address this in a moment, but we can see here that we managed to collect for this week. Let's see, so a bit above, a little bit above $3,200. And the most curious thing about this is that if you look at the date, this was the take that we had only over the course of 3 days. The, because on Thursday and Friday there were simply no trades to do. There were none of the positions that we had were in a position to be closed profitably, and neither on Friday when there was a complete collapse in the metals market. Now, looking again at the trades that we did, we can see here, and I'm not going to go through all of them, and perhaps it's better to look at what happened in here. So basically, we, as I mentioned in the previous video, we sold a call on the junior miners here. We were in a position to make $100 in a capital gain, which of course never materialized given the slump that happened on Thursday and especially on Friday. I did not bother at the time to roll down the position to our cost basis, which is 33, simply because the way the markets open every day on not every day, but both on Thursday and Friday, and looking here at the map of the week, for example, for the junior miners, you see here that immediately here we were very close already to the cost basis. This was still a situation in which we could have been we could have still had this 100 shares sold because the call would be exercised, and I was considering already rolling down here to the 33 and 50, but I felt that let's see, we don't, there's not much upside by rolling down. I might as well wait and keep the window open to have a potential gain of $100. But this completely backfired on Friday because of this huge gap that happened, and because of this situation, which happened in all of the metals ETFs that we trade. Yeah, by the time we open here at this particular price, it was already irrelevant rolling down, because even if we roll down, the premium that we would receive would be just a few cents, or cents on the share, and which means it would be something like $3-4 on the total on the position on the call. So I felt that, yeah, this is an opportunity that is already lost, so there's no point in downgrading anymore or rolling down anymore. Another thing that happened, and let's see here, so the XLF, yeah, this call was very much in the money for most of the first half of the week, all the way until Wednesday, but then it came down, and because this is already our cost basis, I decided I'm not going to do anything, just going to let this call expire. and keep the premium because there's nothing else we can do. We are not going to sell below our cost basis, so that's pretty much it. Nothing to say about these three because these three positions that we had, we were never in a position to close them because the prices never went too far up, and so we basically kept them. Yeah, and that there was nothing we can do. The markets continue to come down. The ETF shares continue to come down thick and fast. You see here, just on Friday, they came down close to 8%, GDX and GDXJ. EAU was somewhat better, but still it was not enough for us to avoid the assignment. The regional banks, we were assigned after trading very close to the money. The puts that we sold trading very close to the money for most of the week, and that's also the reason why we never rolled a position. We never closed it to open another position because we could not do it profitably. So that's why we were also assigned. Um, and yeah, you can see here we only managed to open these positions after the ones that I showed in the previous video, so not that many, and it's a far cry from what happened in the week before here. But then, yeah, the XPI was the same thing. We could not, the biotech ETF, by the way, we were never in a position to close the position properly or profitably, and the same with this ARKK shares. And if you recall what our position a couple of weeks ago, we remain again with 400 shares. That time was only 300, but now it's 400 shares at the exact same cost basis of 75.5. Yeah, I should have a warning that after we sold those shares to try to avoid this strike price as much as possible, because this is becoming a karma, sort of a karma for us, this strike price. In terms of the positions that we managed to open over the week, here these positions basically were closed, and we here we got some more shares of GDXJ, and this was a risk that I took. I was aware that this was a big risk, but given the situation, yeah, this risk basically bitten us in the face, because we now have 2100 shares of SLV, because we basically sold two puts with a 76.5 strike price and 19 puts with a 75.5 strike price. Again, the same strike of the IRKK came again back to bite us, and now we are in a situation in which we have 21 calls to sell for next week, and we are unfortunately some way away from the strike price. So I expect that this will be another dry week for us, and we will have to do whatever we can to try to lower the cost basis of this, even though it's going to be very difficult because this position is already fairly large. It's not KKK, QQQ like position in terms of its size, but it's roughly half of the size, which is already significant enough. And yeah, of course, we see here that beyond that we have these 21 shares, this put on the XLF that we even sold. Yeah, this expired, so we have nothing to do here, and we just kept the premium on this. And so now next week we have to sell a lot of calls, and we will see what's going to happen. I'm expecting that this week is going to be a rather dry one for us, because we are going to sell the calls anyway, and if the markets bounce back, the metal markets bounce back quickly, it will simply result in unrealized losses on the calls, but that also means that we will be able to sell the shares. So I'm not counting on that on the next week to be a very generous one for us. But again, I have to say that, and looking at what happened in the stock market yesterday on Friday, the strange thing about what happened is that the stock market came down here, as you can see, which makes sense because it has been rising a lot over the past couple of weeks, even though with a very hot inflation level being announced, the market continued to rise. Now, it's normal that the market takes a breath and takes some gains off the table. Investors take some gains off the table for them, which is normal. But not only that, what happened, and you can watch the news, I don't have a news piece in here ready, but basically what happened is that the yields started to rise because of the bigger expectation that the Fed will increase rates. So you see the delay in that kind of reasoning for the investors. The PPI and CPI came earlier in the week, and only 2 days later, the investors realized that the probability that interest rates may go higher is 2 days later. So this dissonance for me, it's very strange. It's really something that, yeah, tells me how irrational the market is behaving at this point. But when interest rates go up, yields also go up, which is normal, and the currency tends to appreciate. But because of this, investors simply saw that the metals become less attractive because if the dollar continues to gain, which benefits us because we are very much exposed to the dollar, we uh, we will suffer a loss in the metals because the metals are sort of a refuge to a falling US dollar. And so, given that situation, the dollar appreciated a bit from about 118 to 116. So it is some gain, but this had the ripple effect of completely decimating the metals markets. And yeah, this is something that now we have to contend with. I don't regret at all what I did. The only thing that I probably regret was basically having such a large position on the SLV. That's a good thing that actually this ETF is quite liquid relative to the others. That is also the reason why I built such a large position, because the premiums that were being given were higher than the other ETFs. That's why I built such a large position, and also because I know that the option chain is fairly deep, considering it's a metals ETF, and so yeah, now we have to wait and see what's going to happen next week, because honestly, after seeing the market behaving in such an unpredictable way, I have no idea what's going to happen. I believe that probably the markets will go up in the sense of we are in a run up for the earnings of the most important company today in the stock market. But I know that, and I haven't seen the news piece, but on the geopolitical front, there are renewed tensions between the US and Iran. Now, that in theory should propel the oil markets and should propel the metals market. But at this point in time, with all this situation going on in the markets, I have no idea what's going to happen. This kind of erratic behavior by investors is really keeping me completely clueless about what's going to happen. And so, yeah, who knows? But for next week, besides Nvidia earnings, I had a look at what's going to happen next week, and basically, besides the minutes of the Fed's May FOMC meeting, I don't see anything else being close to able to or close to be market moving. And so I think, yeah, next week is going to be pretty much the single focus of investors is on Nvidia earnings. I have already had a look at our total profit so far. And oh, by the way, this is the average prices of our of all our holdings. Here you see I calculated already the cost basis, so this will be important for us to establish the strike prices for our calls next week. But I also saw that our take for the challenge at this moment is around 90, is a little bit more than 95. We ended up benefiting because even though we only collected $3,200, basically because the dollar appreciated quite a lot this week. We got a bump in the amount of profit taken, or yeah, basically yeah, the profits where we stand at the moment. And so this is something that is also cool for us in that sense, because it propels us further towards the end of this challenge. So we'll see what's going to happen. For the time being, yes, this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we will reconvene next week to start the week number 95 in this challenge. And I'll see you there.